Short-term funding alternatives. Both non-financial corporation and financial institutions depend on borrowed capital to support their short-term activities. So in this video, we are talking only about cash flow management for short-term needs. So basically borrowing only for short-term borrowings. Corporations utilize external short-term financing to cover cash needs during their cash conversion cycle. So cash conversion cycle is the time it takes to sell your inventories, maintaining liquidity. So this is cash flow management. So managing cash flow such that you can meet your operating expenses and benefit from supplier discounts. So the thing is, when you buy from a supplier, you don't have to pay immediately. So it will be in your payable account. But if you're able to pay off earlier, you'll get a discount from the supplier. In this case, it makes sense for the company to optimize its cash flow management as to maximize the benefit from supplier discounts. Sources and users of short-term funding for non-financial corporation. Note that we're only talking about non-financial corporation. So working capital is referring to short-term assets and short-term liabilities. For the short-term assets, it usually comprises of cash, short-term investments such as treasury bills and notes, account receivables. So these are revenue that the company recognize but yet to receive the cash. And inventory is just goods that are bought but not yet sold. As for short-term liabilities, as we talked about earlier, the accounts payable. So these are goods that you have bought but hasn't paid the cash yet. And short-term borrowings, which will be the focus of this video. Non-financial corporations often rely on financial intermediaries, such as banks, for short-term financing. So common banks' short-term instruments include uncommitted bank lines of credit, committed bank lines of credit, and revolving credit agreements or revolvers. For uncommitted lines of credit, so these are the least reliable form of bank borrowings for a company. A bank offers these credit lines up to a certain principal amount. So the banks would offer these up to only a certain amount and only for a predetermined maximum maturity. The company can draw on the lines of credit anytime the company wants, but it's only made up to a certain amount. And this line of credit is only open for a certain duration of time. There is no guarantee that the bank will continue to roll over the line of credit when maturity comes. And also because this is uncommitted, the principal amount is not guaranteed. It is only up to a best effort basis. Interest is charged at the base of market reference rate plus an issuer-specific spread. So this issuer-specific spread is the credit risk spread on the company. And it's on the outstanding principal for the period of use. So these are on the outstanding borrowings. Companies often find uncommitted lines to be the most flexible and least costly means of external funding. The reason why it is the most flexible is because there is no formal written document, and least costly because the company doesn't have to pay a fee to use it. These lines are usually offered on an unsecured basis to clients with stable cash deposits. So the company will already have an account with the bank, a cash deposit account at the bank, and unsecured basis just means that the company doesn't have to post any collateral. Banks can closely monitor borrower activity and react to adverse developments such as declining account balances. So the way it works is that because the company already has an account with the bank, so when it hit overdraft, it would start drawing on the uncommitted lines of credit. So the bank will already know when the cash level on the account is approaching negative. So prior to that, the bank would have already notified the company. And once they start drawing the lines of credit, the bank can also probably try to assist and work out on the cash management. Uncommitted lines, credit lines require minimal capital reserves until the cash line is drawn down and used. What this is saying is that the minimal capital reserves is from the bank's perspective. So the bank needs to keep required reserves with the central bank. So in terms of uncommitted credit lines, the bank doesn't need to keep capital reserves. But when the credit line is drawn, the bank will have to keep the required reserves. Because it's uncommitted, banks reserve the right to refuse any requests for the use of the line. Firms also cannot rely on uncommitted lines as a primary funding source because banks may choose not to lend if economic conditions deteriorate. So the way the company is supposed to use the uncommitted lines of credit is only for very short-term use and only for short-term cash flow management. That means they are expecting the cash to come in very quickly, so it's only a very temporary use. Alternative funding sources can be difficult to obtain or prohibitively expensive when uncommitted funding is unavailable. This is saying that if you're not able to draw on the uncommitted line of credit, it will be very hard for the company to find alternative fundings unless you are paying a very high interest rate. So the primary attraction of uncommitted lines is that companies do not pay any compensation other than interest on the outstanding balances. From a bank's perspective, these lines help maintain long-term business relationships with the company and also monitoring borrower activity, as we have stated earlier. Funding for these lines often comes from stable deposits held by the bank using funds that depositors do not regularly withdraw. Sources of funding for the bank itself for these uncommitted lines of credit is mainly from the depositors. Committed lines of credit are more reliable because they involve a formal written agreement. So this requires more bank capital than uncommitted lines. Remember that for uncommitted lines, reserve capital is only required when the cash is drawn. But for committed lines of credit, up to the level that is committed, the bank will need to have required reserves. Because having required reserves is costly for the bank, you can imagine that the bank will charge a fee to the companies. For larger corporate borrowers, banks often form a syndicate. The reason for this is to reduce the committed capital, which is the required reserve needed to support the line. The structure of a syndicated loans. So we have the lead arranger. The lead arranger is the bank that typically takes the lead role as the arranger of the syndicate, which is probably the bank that the company has an account with. So the lead arranger will structure the loan and negotiate terms with the borrower, which is the company, and coordinates the syndication process. The participant is other banks agreeing to provide a portion of the total credit commitment, and each participant may have different roles and responsibilities depending on their involvement. So these are basically just banks that are sharing the line of credit, including the capital requirements. Revolving credit agreements are also referred to as revolvers. These are agreements that provide the most dependable source of short-term bank funding for companies. The characteristics of revolvers that they typically span multiple years. So the thing is, you are able to revolve, or you can keep rolling over the maturity of the line of credit. But as you can probably imagine, that this will be very risky and costly for the bank because of the fact that you have to keep capital reserves in order to for these agreements. But in order to lessen the bank's risk, the banks will often impose protective measures, such as covenants, similar to those covenants in bond agreements. So these are just agreements such that the companies doesn't take excessive risk that might jeopardize the bank. So additional features of a revolver is that it includes borrowing rates and commitment fees. So this is the same as the commitment fees for the committed line of credit. They also offer optional medium-term loan features. So these are additional features that are found in medium-term notes, and they can offer it as a feature for the revolving agreement. Now we come to a secured loan. The line of credits that we talked about before, those are all unsecured. So the banks can just draw on the line of credit without pledging any collateral. But for secured loans, the company will need to pledge a collateral, and the collateral could be fixed assets or high quality receivables. So these are accounts receivables, inventory. So these are the goods that are bought but not yet sold, or marketable securities, which are the ones that we are more interested in this video. Assets are pledged against the loan, with the lender filing a security interest. So this is just the administrative stuff. The pledge or lien is recorded in the borrowing company's financial records. The company's credit report, it will be listed as a collateral. So in other words, you're not able to use the asset as a collateral for other loans, or it would not be seen as aiding in the credit score of the company when it's already pledged. So it's used by companies lacking sufficient credit quality for unsecured loans. So in order for companies that do not have a good enough credit quality or a long enough historical credit history, so the only way these companies could borrow is only via secured loans.